Good morning guys, welcome to my channel Learn Accountancy with Prasadar. This is part of the weekend series. This happens to be session 3 of the weekend series. Today we'll be discussing about IND AS 23 borrowing cost. Before we get into the standard, let me ask a simple question. When company takes a loan and pays interest, should it be expensed or should it be added to the cost of the asset? This one question is very important to determine whether the profit of the company will go down today or it will be spread over multiple years. IND AS 23, this standard IND AS 23 tells us when borrowing costs are expensed and when they must be capitalized. As we always say, my previous discussions also I have mentioned, before getting into the standard, it's very important to understand what is the reason this particular standard has been framed by ICAI, and other international boards also they have similar standard. This standard will help us determine when borrowing costs are expensed and when they should be capitalized. This is very important for those who are preparing for the CA or CMA exams, and also for those who are in corporate practice or who are in industry or who are in the industry actually. Clear guys? Now, the core purpose of IND AS 23. What is the core purpose of IND AS 23? The objective of this standard is to prescribe the accounting treatment of borrowing cost. As we go further, we will be discussing about what is a borrowing cost, what is a qualifying asset. We will get into those discussions later. So this standard will tell us what should be the treatment of borrowing cost. General rule is borrowing costs are expensed immediately to profit and loss account. See, borrowing cost is nothing but interest. That interest that you pay on the loan is borrowing cost. The general rule always is any interest has to be expensed off in the profit and loss account. Exceptions, but there is an exception, and this exception is what will be dealt extensively in this standard. Borrowing cost directly attributable. Every word has a meaning guys. To qualifying assets must be capitalized. So they have mentioned about directly attributable plus qualifying asset. So if the borrowing cost is directly attributable to a qualifying asset, it will be capitalized. Now the question is, what is borrowing cost directly attributable? What is a qualifying asset? The majority of the standard will revolve around discussion on qualifying asset. Okay, so let us understand each of this terminology in detail. So at this moment, just understand the general borrowing rule is any interest has to be charged to profit and loss account. Exceptions are borrowing cost which are directly attributable to qualifying asset, they have to be capitalized. Clear guys? Now, when does this standard apply? When does IND AS 23 apply? IND AS 23 applies to all borrowing cost with specific exceptions. Applies to all borrowing cost in general, interest on loans and debenture, finance charges on lease, costs related to fund borrowing. Okay, so it covers mainly interest. Borrowing cost is nothing but interest. Borrowing cost is nothing but, simple words I am telling. Borrowing cost is nothing but interest. Okay, but what exactly is a borrowing cost? That also we will be learning in the subsequent discussion. Does not apply to qualifying assets which are measured at fair value. So as qualifying assets which are measured at fair value, the standard do not apply to that. Inventories procured in large quantity on a repetitive basis, like FMCG inventory. So FMCG inventory, this borrowing cost cannot be capitalized. So there are two exceptions to this standard. One is assets which are valued at fair value, no capitalization is allowed, and FMCG inventory. So applies to all borrowing cost, interest on loan, finance charges, and costs related to fund borrowings. Now, this is what I was telling. Let us understand what is a borrowing cost, guys. In simple terminology, borrowing cost is interest expense. This everyone knows. Whether it's an interest on loan, overdraft, debenture. As per the standard, the language that is given is borrowing cost are interest and other cost that an entity incurs in connection with borrowing and funds. Okay, so borrowing cost are interest, which everyone is aware of. This everyone is aware that borrowing cost, when a company takes a loan, an interest is incurred, that is a borrowing cost, and other cost. So this word now takes significance, and other cost. So what will come in other cost? If finance charge under lease liability, amortization, discount premium, and ancillary cost spread over time. Okay, ancillary cost spread over time, exchange differences to the extent regarded as interest adjustment. Okay, exchange differences to the extent regarded as interest adjustments. Clear? So see, in exchange differences also there is an element of interest involved in it. So to the extent it is an interest element is involved in an exchange difference, that also will form part of borrowing cost. Clear? So for now you can just remember borrowing cost are interest and other cost that an entity incurs in connection with borrowing of fund. It can be like when you go for a loan, you have to pay some processing fee. That processing fee will also be treated as a borrowing cost, interest and other cost. Clear, guys? So it will include what? Processing fee also can be included. Processing fee can also be included in borrowing cost. Clear? Now, this is the most important understanding of the standard. See, one is when borrowing cost can be capitalized, only when it is a qualifying asset. A qualifying asset is an asset that necessarily takes a substantial period of time. The wording that is used is substantial period of time to get ready for its intended use or sale. Substantial period of time to get ready for its intended use or sale. So each word has again a meaning, guys. First of all, what is a qualifying asset? Qualifying asset is an asset that take necessarily a substantial period of time to get ready. That means something which is already ready will not form part of a qualifying asset, right? So something which is already ready, like for example, if I am going to purchase a furniture today, that furniture is readily available. If I am going to buy the furniture on EMI option, the interest that I pay on that furniture cannot be capitalized because it does not take substantial period of time to get ready for its intended use. So one condition is it has to be an asset. Second condition is it takes substantial period of time to get ready. Substantial period of time to get ready. So that means something which is already ready, that cannot be treated as a qualifying asset. So three components to this is, one is it necessarily, that means the time requirement is inherent to the asset type. That means it will definitely take a longer time. Substantial period of time means significant time needed for completion. That means to complete the asset, a significant time is involved. A significant time can be a period of more than 1 year. For its intended use or sale, that means to make the asset ready for its intended use, it takes a substantial period of time. Okay. Now, few things that you can ask yourself: can this asset be used or sold immediately? Can this, if I am going to buy an asset with a loan option, can I use the asset immediately? If the answer is yes. For example, you are going to purchase a car. You are going to purchase a car on a loan. on an EMI option. So the car, the moment you purchase the car, it will be already registered with the RTO. You can immediately use the car from the same day from the showroom itself. You can drive it back to the home. That means the asset is already ready for its intended use. It is not a qualifying asset. That means the loan or the interest component on the car cannot be capitalized as a borrowing cost. Clear? So it is not a qualifying asset if no, it does not need a longer time. So again, coming to the definition, I am spending more time on the definition so that the definition is very clear. A qualifying asset is an asset that takes substantial period of time. That means it takes a longer period of time to get ready. Take an example of, there is a land actually. You are going to construct a building. When you take a loan for construction of building, building will take substantial period of time to get ready, right? It is not readily available. Once you start the construction, it will take substantial period to get ready. So the building or that asset will be qualifying as a qualifying asset actually, which takes substantial period of time to get ready. So if there is a land and you are going to construct a building on that, so it will take substantial period of time to get the building ready for its intended use. That building, the interest cost which is incurred till the time the building is ready to use, that period of time, the standard will tell us whether we can capitalize that interest or not. Okay, so first of all, we have to identify whether the interest which is the borrowing cost which is incurred is for a qualifying asset or not. Okay, so three conditions has to be satisfied. It has to necessarily, means the nature of the asset should be such that it necessarily takes a substantial period of time for its intended use or sale, guys. Clear? So qualifying asset, very technical term used in the standard, very important term which is used in the standard. If in the standard, if you are clear about borrowing cost, what is a borrowing cost? Like we discussed about interest and other cost. And if you are clear on what is a qualifying asset, then the standard will become very easy to you guys. Clear? So again, repeating, what is a qualifying asset? A qualifying asset is an asset that takes substantial period of time. That means if something is ready to use, it cannot be a qualifying asset. It should take substantial period of time to get ready for its intended use. Clear, guys? Examples of qualifying assets. Examples of qualifying assets. Manufacturing plant. See, generally a plant takes a larger time to get ready for its intended use. Power project. Reliance is having power projects. The power projects that Reliance is having. Large real estate projects. Builders like DLF. Builders like Hiranandani. Builders like Naveens. All those real estate projects, they take longer time to get ready for its intended use. Self-constructed intangible assets, investments property which are under construction. So construction, as I mentioned, we have a land, we are going to construct a building. So definitely that is going to take substantial period of time to get ready for its intended use. Okay, so those are all qualifying assets. Assets ready for use when acquired. If you purchase a car which is readily available for use, cannot be capitalized. Inventory procured routinely like FMCG goods cannot be capitalized. Financial assets, we discussed in the first slide itself, financial asset cannot be capitalized. Standard equipment purchases, it cannot be capitalized. All this cannot be capitalized, guys. All this do not form part of qualifying assets itself. When to capitalize borrowing cost. So far we have discussed what is borrowing cost, what is a qualifying asset. This is another very important part of the standard. When to capitalize borrowing cost. Three conditions are given in the standard. Borrowing costs that are directly attributable to the acquisition, construction or production of a qualifying asset shall be capitalized at part of the cost of the asset. Okay. So borrowing cost, which are directly attributable. Directly attributable cost means cost that would not have been incurred if the asset was not constructed. See, if the asset is not getting, we are not constructing the asset. Okay, so we will not incur certain cost. If we are going to construct an asset, lot of costs will be incurred actually. So any cost which is incurred to construct the asset, that will be treated as directly attributable cost. Okay, directly attributable cost with respect to acquisition, it can be a new asset purchase, it can be a construction, or it can be a production of a qualifying asset, shall be capitalized as borrowing as part of the cost of the asset. Okay. Now, commencement of capitalization. Capitalization starts when three conditions are met simultaneously. See, we spoke about qualifying asset, we spoke about borrowing cost. But when can we start capitalizing? When can we start adding the interest cost to the cost of the asset? Okay, first is the expenditure on asset should be incurred. That means we should start spending money on the asset. That means if a land is there and we are going to construct a building, then we should start spending money on construction of that building. Okay, so when money has been spent on the qualifying asset. Okay, so if a building is getting constructed, the money should start getting spent in construction of the building. Second is borrowing cost being incurred. That means we should start paying the EMI, we should start paying the interest on that loan. Interest and related costs are actively accruing. Okay. And third one is activities in progress. That means the construction should continue. So if money has been spent on construction, we are paying the loan along with interest. And third, the activity of construction. The construction activity is in progress. If all these three conditions are cumulatively satisfied, then only we can capitalize the borrowing cost. This is a cumulative condition. This plus this, this plus this plus this, all conditions has to be cumulatively satisfied. Then only the standard allows us to capitalize the borrowing cost. One condition is not met. Like for example, we are not incurring any expenditure to construct the asset. We cannot capitalize the interest. This interest cannot be capitalized. There is no activity in progress. The work has stopped for some time. The construction has stopped for some time due to COVID. Borrowing cost cannot be capitalized. Clear, guys? If the activity for construction stops, we cannot capitalize. If the borrowing cost itself is not incurred, obviously if the cost itself is not incurred, we should not capitalize that borrowing cost. If expenses are not incurred on the asset, we are not spending anything on constructing the asset, then also we cannot capitalize the asset borrowing cost. Clear, guys? Very, very important conditions, guys. These conditions can be tested in the exam, can also be tested during interview. Now comes a concept called specific versus general borrowing. Okay, loan taken specifically. See, I have taken a loan of rupees 50 lakhs for construction of a building. So whatever interest I pay on that 50 lakh loan for construction of a single building can be capitalized. Okay, capitalize the actual borrowing cost incurred on that specific loan. So in case of specific loan, it is very simple and direct because there is only one asset, there is only one loan. Here only is one asset and one loan. So all the borrowing cost incurred with respect to this loan, all the borrowing cost incurred with respect to this loan for this asset can be capitalized, provided the three conditions are met. What are the three conditions? And money should be spent on that asset. Second, borrowing cost should be incurred. Third, the activity should be in progress. That means the construction activity should be in progress. These are the three conditions of capitalization. If these three conditions are met, we can capitalize the borrowing cost. Okay. Now, general borrowing. Multiple loans are there, not specifically tied to one asset. See, we have taken loan from Punjab National Bank. We have taken loan from ICICI Bank. We have taken loan from HDFC Bank. There are multiple loans we have taken. And these multiple loans are tied not specifically tied to one asset. It's not related to one building. It With that loan we have purchased building also, we have purchased plant and machinery also. Okay, so in such case what we do, we use a capitalization rate based on weighted average borrowing rate, weighted average borrowing cost. So if there are multiple loans, we calculate the weighted average borrowing cost. So calculate average rate across all general borrowings and apply to qualifying expenditure. Okay, so expenditure also we have to see how much of expenditure will qualify, how much of expenditure will qualify for capitalization. So on one side we have to identify the expenditure which will qualify for capitalization. On another side we have to take the weighted average rate, weighted average cost of borrowings. We have to apply those rate for capitalization. So this is in brief about general borrowing. Maybe you can look into some examples to understand more on general borrowings, guys. Suspension and cessation of capitalization. See, if you remember the commencement of capitalization, there were condition that there should be cost incurred, activity should be in progress, borrowing cost should be incurred. Okay, for suspension, capitalization of shall be suspended during extended period in which active development is interrupted. The last condition of capitalization was activity should be in progress. If activity is not in progress, like for example, because of COVID, for 2 years, all the construction activities were halted. So when the activity is halted, temporary halt due to labor strike, no capitalization. If there is a strike, we cannot capitalize the borrowing cost during the period of strike. Legal issues causing delay, no capitalization. Normal technical delay, we can continue capitalization. See, something which is in the normal course of business, we can definitely continue the cap. Sunday holiday, we cannot uh, reduce the cost for Sunday and see and reduce the capitalization. Okay, so suspension of capitalization. Suspension means it's a temporary hold. It's a temporary hold on capitalization. When the strike is over, capitalization can start again. Cessation of capitalization. See, capitalization of borrowing costs shall cease when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. In simple words, if the asset is ready, see the wordings that is used in the standard is when substantially all the activities necessary to prepare the qualifying assets for its intended use or sale are complete. Means all the activities have been complete, only some minor work is pending. That is when we have to stop the capitalization. Asset must be ready for use. In short, if the asset is ready for use, not actually being used, completion of preparation is the trigger. Okay, that means the moment the asset is ready to use. See, now we were constructing a building. The building is ready on 1st of January. Okay, the inauguration is happening on 1st of February. So we should stop. This will be the point when till when the borrowing cost can be capitalized. During this period, the borrowing cost cannot be capitalized. The inauguration can happen at a later date, but inauguration is not a condition to make the asset ready for its intended use. Clear? On 1st of Jan, if the asset is ready for use, we should calculate the interest only till 1st of January, and till then the interest can be added to the cost of the asset and can be capitalized, guys. Clear? It can be tested on cessation and suspension also in your CMA exams. Disclosure requirement is simple. Uh, what is the amount that is capitalized for borrowing cost? What is the total borrowing cost capitalized during the period? What is the capitalization rate? What is the rate used for general borrowing calculation? Okay, disclosures. If this question comes in exam, it should be an easy pick for you. You should be in a position to answer it very clearly. For detailed disclosure requirement, you can refer the standard also, guys. Now, final summary. General rule, borrowing costs are generally expensed in profit and loss account. That is a general understanding that we had before reading the standard. That means all the interest is always expensed to the profit and loss account. But this standard was specifically to understand when borrowing costs can be capitalized. Exceptions, qualifying asset require capitalization of directly attributable costs. So this standard talks about when a borrowing cost can be capitalized. Three conditions. Okay. You should be very clear on when borrowing cost can be capitalized. Three conditions that we discussed was, one, there should be some amount which should be spent on the asset. Second, borrowing cost has to be incurred. And third is the activity should be in progress. Okay. Other than that, we discussed about borrowing cost in this standard. We discussed about qualifying asset. Qualifying asset is an asset which take substantial period of time to get ready for this intended use or sale. Okay. These are the three conditions. Okay. So we discussed about suspension and cessation. Whenever the asset is ready to use, that is the point then that we should suspend the capitalization. Clear, guys? For more accounting concept, follow my YouTube, Instagram and Facebook handle, Learn Accountancy with Prasadar. In all these handles, I am available by the name Learn Accountancy with Prasadar, and my LinkedIn profile is Prasad Ramachandran, guys. Happy learning and have a great weekend, sir. Weekend ahead. Thank you, guys.